Don't expect high rates of return over the next 10 years. This is from an article I just read from AQR, Asset Management or Capital Management or something like that. A guy named Cliff Asinus or some of that is a founder, I think, of this AQR. And I like the research a lot, actually. I'm not a fan of Cliff, though. The guy's screeching bloody murder, anti-Trump stuff. Weird. It's just, I was like, dude, I don't know. Like, unhinged. I'm like, are you managing money? Is this just weird to me, man? But anyway, he didn't write this article, but Cliff Asinus goes back a long time with AQR. There's just, I don't know, man. It's weird. I think some of these rich guys, they just have nothing else to do with their money. And so they, or their time, because they're like, I don't know what to do. I got so much money. So they just start going off these tangents. They just sound like crazy people. Like, do you really want these people manage your money? It's weird to me. But anyway, with this said, so one of the guys did a look at that, dude. That's Maui. Dude, that's freaking, it's gorgeous. I like Hawaii, not gonna lie. It's better than Cancun. I don't care what anybody says. But Florida, I mean, look at the beach. I don't know if I can see. Well, I'm not going to show it to you. The beaches are nice, but, you can get all this in Florida where people, where you don't have to fly freaking 10 hours, dude. I mean, I like it, but ain't all that a bag of chips relative to what you get in Florida, I'll tell you that right now. I mean, I guess you got islands and stuff, but you'd have some, man. All right, so going back to this article I was reading while sitting on the beach, because I do my work for you, so don't forget to subscribe, smash. If this article helps you or this video helps you, buy me a cup of coffee down below so I can afford this vacation. All right, so the article says he compared the author, he's an analyst for us, AQR. He compared two things. Looking at the last 10 years to get future performance expectations on portfolios, or looking at your expected cash flow growth scenarios of stocks. And stocks being companies from which the stocks are traded on. There is a significant negative correlation. This is crazy for the last 10 years. So if the last 10 years average 18%, and you think the next 10 years is going to average something like that, not only did it not even come close to 18%, it was almost identical in the negative. It's crazy. I posted this on my, I think I even posted on this page, as a matter of fact, right here on YouTube. But I post on my various socials, media, LinkedIn, Facebook, and then X. So if you're not following me there, what the hell? It's very interesting, though. So basically, if you're running your projections, your CMA, capital markets assumptions, what you expect for rate of return based on the last 10 years, there's a high probability that you're going to be way off. In fact, a negative correlation between what the returns you got the previous 10 years and what the future returns will be. It's crazy. So again, it's a negative 0.37 or negative 37% correlation. So I guess if you got 10, I don't know if this will math out, but if you got 10, then you get negative 3.7. Is that how it would be? 37%? I don't know what it is. Something like that. But anyway, and you can see this graph. If it goes up, the next is crazy. I'm like, damn, it's stunning. If you're using the last 10 years as your capital market assumption going forward, it's like you're going to be almost 100% wrong. It's crazy. Now, again, could that change? Sure, I don't know. But what the other one was what I go back to John Bogle's strategy is earnings growth expectations plus dividend yields, plus or minus appreciation, or in terms of price to earnings ratios, in terms of we feel have higher PE ratios or lower PE ratios. And I don't know how you predict that. But so Bogle said, look, we can predict with pretty good clarity, and we could certainly be off, but within 10 years, we should be pretty smack dab right there, close. Earnings growth year over year plus dividend yield. Now, what Bogle did not say, because this was the beginning of his, when he wrote about this in Common Sense on Mutual Funds, was in terms of stock buybacks, where instead of using money for dividends, we have stock buybacks instead. So you could use stock buybacks, earnings growth year over year, dividend yield if you want to use three things. I don't know how you do contraction on PE ratios or expansion on PE ratios, because that's just speculative. We don't know. But anyway, earnings growth plus dividend yields. It's a great place to start. And what the guy from AQR found, if you did that, it was a 52% correlation. Not great, but it's better than half. Essentially, if you thought, you get 10% earnings growth plus dividend yields, and the market would give you 5.2 or something. I'm not getting the math right on that, but you get it. There's a positive correlation is more than positively correlated. It had a positive correlation, 52%, which is pretty good. Unlike the other one, was this 37% negative correlation. My face look all red. You know my teeth? You sterling teeth? Just got to eat lunch on the porch. I was able to cook up some hamburgers and Hawaii-style hamburgers, which has some pineapple in there. You ever put marinated your hamburgers in pineapple juice? That sounds pretty good. Or marinate your chicken. I was telling my wife, I said, man, we got to marinate some chicken in pineapple juice. That sounds good. Anyway, so the last 10 to 15 years, we've had probably the biggest bull market, I mean, probably ever. 82 to 99 would be the only thing that competes with it. And off the top of my head, I'm not sure which is better. I think 82 to 99 was better. I think 82 to 99 was better than from 2009 to 2025 or 24, excuse me. But don't quote me on that. I think either way, if your expectations are we'll get another similar rate of return a la the last 15 years, you're going to be most likely sorely confused. Sorely confused. What the hell? No. You'll be ill-advised to make that projection based on historical evidence of using the last 10 years. Now, what the guy said is if you use last 30 years, all right, and he didn't really give a graph on this, but just said, yeah, you can be pretty close to that if you use the last 30 years for your capital markets assumption. So, because the longer you get, because there's only so many years in the modern stock market, we just don't have that many 30-year periods. So the longer you go out, the more likely you'll be close, certainly a positive correlation. So you say the last 30 years, the market was up 8%. I should have saved, I think an 8% forward expectation should make sense. That's fine. But again, it's all based on earnings growth and dividend yield. I mean, that's what the stocks are based on, earnings growth and dividend yield. If we don't have earnings growth, I don't care what the last 30 years did. If we don't have earnings growth, we're not getting future rate of return historically, like we did historically when we had earnings growth. It's just not going to happen. If we have high earnings growth, you're going to have a higher rate of return than what you had historically as well. And again, if the last 15 years were low earnings growth, it's just earnings growth drives this, man. I'm just telling you right now. Part two of this too is the price to earnings ratios. High valuations should lead to lower future rates of return using the cyclically adjusted price to earnings ratio. When he does it, an inverted cyclically adjusted PE ratio, he calls it a cyclically adjusted inverted yield curve. PE ratios divided by earnings. PE ratios, the PE ratio divided by, I can't remember. So, the earnings yield was the PE ratio. I forgot. But anyway, it's the inversion of this cape, and I forgot how they did it. Earnings divided by price is what it is. So the earnings yield, earnings divided by price. So instead of doing cyclically adjusted PE ratio, cyclically adjusted earnings yield, which is earnings divided by price. Whatever. But anyway, the point being is because you have such a high level of valuations, that usually leads to slower rates of return in the future when you factor in the next 10 years over the last 10. And I actually think there's something to be said about that. So look, if I'm trading at a PE ratio of 30, whereas in 1982 I was trading at a PE ratio of 8, pretty good chance that the PE ratio of 30 won't grow to a PE ratio of 40, and as such will probably have price to earnings contraction, no more expansion. It might level off, that's fine. But because you have PE ratio most likely contraction, the PE ratio will probably go from 30 to 20, which would reduce the potential upside for sure. Unless the earnings growth just takes off like a bat out of hell. I know this is hard to figure out on why I'm not doing it on the chalkboard, but I just want to yap about this for a little bit. If I have PE ratio that's contracting, the only way to offset that is an insane dividend yield increase, which not going to happen. Massive stock buybacks, which eliminates shares out there, which just not going to happen. I mean, it's going to happen a little bit, but not that much. Or massive earnings growth, more earnings growth that will offset those three. And it's just not, you're probably not going to see that in terms of a massive offset of PE contraction to earnings growth. In fact, if earnings growth takes off like that, it would be no PE contraction to begin with. So if we don't have people willing to pay $30 a share for a stock, but they're more likely to pay $20 a share, well, that usually signifies that the earnings growth is going down anyway. So then you have lower earnings growth, which increase your PE, your dividend yield, like grant you, but then you have lower price to earnings ratios contraction, which will portend very poorly for future stock performance. Anyway, something to think about. I think I yap when I'm sitting on the beach and look at that, dude. Oh man, it's nice, but USA or bust, baby. I'm going to Cancun, says a couple of people on YouTube channel or Facebook. I stay in America, dude. American made, American built, 100%. God bless.